We're here to give you a better understanding of the Silicon Valley real estate market as of December the 6th. These are the key chapters that I'll be going over. You can jump to any one that you find most interesting using the time links in the description below. I would appreciate likes and subscriptions. Let's get into the data. Here's the first data slide. What we're doing here is we're showing the history of the data over the last 13 weeks, the past quarter. We start with this week, we go back one quarter, so a total of 14 data points. You can see inventory started off at 2525. It's now at 1550. So a dramatic decrease in inventory. But if you can follow the gray line and compare it to the purple data line, you can see that for the most part, they're following hand in hand. The reason the purple line dived down last week was a Thanksgiving. Thanksgiving is a holiday that moves a week over the period of several years, and therefore the average for the 10 years is between 2 weeks, which gives you a higher number. So the fact that it dipped down last year is just completely normal. It's one of the things you'll see consistently with using holidays that move. Things like Christmas and 4th of July don't move, and New Year's, but most of our holidays move based on keeping a Monday holiday. Thanksgiving is one of the unusual ones. It's a Thursday holiday. So basically, inventory is decreasing. It typically decreases this time of the year. There's been really no change, as you can see from the current 85% down from 89% back here a quarter ago. Doing the same thing with the number of offers. We've gone from 1,900 to 1,600, so a drop in the number of offers. But if you look, we actually had an increase of percent of normal, 72% to 89. So a fairly significant increase in normal. And if you can see, we were actually below the blue line. So we were lower number of transactions than you would anticipate based on the past 10 years. We crossed over 10 weeks ago, and for the last 9 weeks, we've been above, and right now we're at 81%. We're doing 1,607 transactions over the past 5 weeks. I use a 5-week moving period to sort of simulate a month, but also to sort of stabilize the data. I did look into 1 through 6 weeks, and 4 and 5 weeks was the most common. I decided to go with 5 weeks just because of a few things with the real estate industry. Days unsold inventory is the supply-demand balance, the seller-buyer ratio. And you can see that we started off higher than normal at 46 days, or 15% slower than normal. We're now a little bit faster. I would call it normal, but you're only at 98%, even though your days unsold inventory essentially increased from 50. So you've had basically a 3.5 day slowing of the turnover rate, but that's actually been an improvement because the market normally slows more than that at this time of the year. A related time frame, but one that makes more sense to the consumer, is simply the time it takes 3/4 of the sellers to sell their property, not to close escrow, just to get the offer in. So how long is their marketing period of time? You can see 14 weeks ago, it was 27 days. It's now 41. That's a huge increase. It's even an increase on percentage, 112% to 126%. So 14% slowdown in the marketplace compared to normal. You can really see that for the most part, it's been following the normal trend line, except starting here about 2 weeks ago. 1 week ago, it was up a little bit, and then it's up again this week. So in the last 2 weeks, it's climbed fairly significantly. Based on the data I do have, my best explanation is there's such limited inventory. Buyers that need to buy now for whatever reason are going through the existing inventory, which is inventory that's been picked over by previous buyers, and therefore has a higher number of days on the market. 41 days, less than a month and a half to sell 75% of your inventory. That is still a fairly strong marketplace. Silicon Valley is typically fairly fast paced. Now we're looking at the average price cut. So this is the price reductions that the seller takes from when they first go on the market until they get the offer in the door and accept that offer. Basically 99% of their original ask price, or a 1% price reduction. That is actually 23% higher than normal. So normal would be about an 0.8% decrease. 25% of 0.8 is 0.2. 0.2 plus 0.8 is the 1/10 we're seeing. That's how I calculate this. It's a percentage of what it normally is. So normal would be about 0.8% price reduction. The reason these numbers are so small is the vast majority, somewhere around 85% of the sellers, do no price reduction whatsoever. One, because the market tends to be quick-paced in Silicon Valley. Two, sellers do a lot of research before they put their house on the marketplace, and they put it on to sell, in most cases, versus to test the marketplace, and therefore they get the offer in quickly and don't need to make their price adjustment. We're currently doing a 1.2% price reduction, and that's actually only 12% more than normal. So there's, even though the percent reduction has gone up by 0.2% from essentially 1% to 1.2%, that's been a reduction from 123% of normal to 112% of normal. So it's still more than normal, but again, it's fairly close. And you can see that it's the vertical separation between the purple line and the gray line. And you can see just a couple of weeks ago, it was actually less price reductions than normal. And then you can see the vast majority of the weeks are right at normal. And it's only at the very beginning of the 14 weeks period that it was, again, bit larger price reductions than you'd expect. Overbids is included more as a point of interest. It really is what I call a lagging indicator. The reason it's a lagging indicator is we have to wait for escrows to close to get the sold price, unfortunately. And the duration of escrows varies, and the duration of even the duration of the typical escrow varies depending on the marketplace. As the market heats up, the duration of escrows tends to decrease, so the lag time changes. You can see that we started off 14 weeks ago at 5.6% over the seller's ask price. The typical amount over ask price is 5.1, so they were getting 0.5% more overbidding than typical a quarter ago, which is why the purple line is slightly above the gray line. Fast forward to current day, the typical overbidding is only 4.1%. We're getting 5.4, which is 1.3% more overbidding than typical than you would expect, and that's why the purple line is now above the gray line. So it gives you the recent past history. It gives you an indication of where the data should be and where the data actually is. Now we have the long-term exposure. We're going all the way back to January 1st of 2014. The first 9 years are on a condensed scale coming up through January 1st of 2023. 2023 is an expanded scale, and by expanded on the x-axis, your date time frame, you can see January 1st, 2023 is back here. January 1st, 2024 is way out here. It's about double the horizontal distance of the previous years. And I do that so that you have the 10 years worth of data that I'm using in my analysis. And then you have 1 year, the most recent past year, with the data expanded so you can see trends. And then you have the current year in the same expanded scale. The purple line in this case is the inventory. And you can see the inventory really dip down for Thanksgiving. And when you don't average that out, that's what caused that dip down in the first slide that we went over, the summary slide. But now it's back up to the level it is. So inventory is basically hovering somewhere around 80%, and it does vary, but that's up significantly from the 60% we were a year and a half ago, July 1st, essentially, of 2023. The highest we've gotten is 90%. So there's been a shortage of inventory. You can see before the pandemic, we actually had a surplus, so we're, realistically pretty close to the number. Going into the pandemic, we had a surplus. Since this pandemic, we had a shortage, especially the closer to the pandemic you get, the shelter-in-place release that you get, the bigger the shortage was. And even during the slowdown in 2022, we basically barely got up to normal inventory. So you had normal inventory, but in that case, you had a lack of offers. Offers is the next line that we'll talk about, and that's the orange line. The concepts are all the same, but you can see orange is basically somewhere around 81%. So the three counties, Santa Clara, Alameda, and San Mateo County, are only having 81% of the transactions that they should be having based on the previous 10 years data. And then the ratio, which is the more important one, because that's the supply-demand balance, the seller-buyer balance, is basically right at 100%. It's a little bit low right at the moment, but it's been hovering right around 100%. Which means that the speed of the market, the pressure the buyers feel is pretty close to normal. And that's because both the inventory and the number of transactions are roughly the same. Typically, if you look at this, you'd expect with the inventory being somewhere around 85% of where you'd expect and offers at 81%, you'd actually expect DUI to be slower, which would be up here above 100%. The reason it doesn't work out in this case, just using logic, is each metric is done independently. So the inventory median, the offer median, and the DUI median all are happening in different years, and that's why the math doesn't work out. It comes out close. You're close to balanced, and you're close to balanced up here. The surprising part is you're faster than normal here, where when you look at the individual components, you'd expect it to be slower. That's just the different things you can do with statistics. I try to make it make sense. And if you're confused by something, do reach out and let me know. Now what we're doing is we're looking at each one of the components. You're now looking at the hotter than normal marketplace down here. This is the hottest you'd expect the market to be. The coolest you'd expect the market to be the blue line, where you'd expect the market to be the gray line, and the purple line is the actual data. So you can see that and since this is inventory fell more last week because of the Thanksgiving holiday. This week it's down a little bit, but it's more horizontal and it's getting more in between the middle of the red and black gray line. Now you can't go across like this. You want to be doing vertical separation because that's your date. So you come up here and you cross over the red line right about there, about 1500. So it's the least number you'd expect. We're probably somewhere right around 1575. The typical you'd expect is somewhere up here around 1800. And the most you'd expect is somewhere around 2100. Very difficult to read the vertical scale on this, but you can see that you're currently between the gray line and the red line. So you're between a hot marketplace and a normal marketplace, which means you have limited inventory, but not ridiculously limited inventory. And you can see how rapidly the inventory falls at this time of the year. And again, this is based on the past 10 years. Colored lines are based on 2014 through and including 2023, those 10 years. That's what I look at my data. Starting in January, I'll be using 2015 through 2024. So now what I do is I take the gray line and stretch it out at 100%, and you can see that you're somewhere right around 85% of normal. So inventory is lacking about 15%. You can see we've been lacking inventory for basically the last 2 years, and that's why it's shaded red, is lack of inventory favors the seller. Here's doing the same concept, the previous 2 slides, and it's a set of 2 slides going through the different metrics. Here you can see the number of offers accepted. The number of offers accepted is just a little bit above the blue line, clearly below the gray line. And that says that you're having a lot less transactions than you normally do, but it's pretty much following the normal patterns. You can see we had a major slowdown here during third quarter. And, people can argue all day long on what it's about, but I'm inclined to believe those that hypothesize that it was basically the uncertainty of the change in commission, which to me is a non-issue. And if anyone does have a question about that, just reach out to me. I'd be happy to answer it. So now you're pulling it out compared to normal. So this is normal level of offers up here. You can see we've been basically having abnormally low number of offers, but it's been basically following the normal trend. Although this year you've probably gone, starting in basically beginning of second quarter to now, you have probably gradually increased from 70% to 80%. Yes, there's a lot of fluctuation, but you sort of just draw the straight line through there and say it's definitely been climbing. We're getting more and more offers, which is a good thing for the industry. Here's the days unsold inventory. Here you can see the market is basically dead normal. It's been dead normal basically since Labor Day, pretty much. And even before Labor Day, it's pretty normal. I could come back all the way to probably about November 1st before I would say there was a shortage, which would be a faster paced marketplace. So we basically, as far as the pressure the buyers should be feeling out there, the 3 counties combined, Santa Clara, San Mateo, and Alameda County, has been absolutely normal turnover rate. Here we're looking at the same data. Again, we're stretching out the line. You can see you're a little bit below the 100% line, which is favoring the seller ever so slightly, but you're pretty darn close. It's white because I would consider plus or minus 12.5%. This is interesting here, and this is marketing time. Look at how much the marketing time has slowed down in these last weeks. Yes, we're going back a couple weeks, but even if you go back to here, it's sometime since October 1st, and this may even be since November 1st. It's steeply sloped. But if you look at the gray line is steeply sloped too, except right now we're missing this little improvement. Now, Thanksgiving is a week later than typical. There's a very good chance we'll see this little tiny downward correction next week and then go back up again. But I don't anticipate it to come anywhere back down close to the level of the gray line. What it's saying is the marketing time is going up more dramatically. And as I already explained, I think that's because the properties that are selling right now are ones that were picked over earlier in the year. And now with less and less inventory, buyers that need to purchase have less choice, and they're buying the properties that have been picked over already and therefore have longer marketing times. This is letting you see the dramatic change compared to normal. You can see how, as I was saying, the trend before, even though it was rising steeply, was pretty much normal, because when you look at it on a percentage basis, you're basically just a little bit below 100%. But just in the last week, look how dramatically you've changed. You've changed from something like very close to 100%, maybe 99%, up to something like about 128%. That's a significant change in 1 week. It's clearly just the fluke of the properties that sold. I'm doing a 5-week moving period, so only 20% of my data is new data. But to have that kind of change in new data indicates that you had a fair number of transactions with a high number of days on market sell in this past week. Here's looking at the sellers that are taking the largest 10% of their ask price reductions. This is something you normally don't do in statistics. I'm doing it because if I looked at the median or the average, 85% of my put data is zero. And that just masks the movement. If you look at only the 10%, you can see you're down here and those sellers are taking something like a 14.5% price reduction, which is pretty significant. And you can see it's gotten worse, a little over 2 full percentage in the last 2 weeks. So a fairly rapid increase. Sellers that haven't sold are now doing significant price reductions. That's going to turn around and cause those properties to sell. And those properties that have been on the market for a while, so that's going to cause your days on market time on the previous slide to go up. And I think that's what we have going on. Here you can see the dip, the improvement for the weekend before Thanksgiving. Thanksgiving is going to be this last data point, but you can see you've been running about 15% more price reductions than normal as far as the magnitude for the 10%. Now we're looking at the average. So this slide's on here. It tells you the same information. It's to show that the other side doesn't say anything misleading. You can see the little bit of dip down for Thanksgiving, the huge dip down the week after Thanksgiving, the current week, and you're now significantly below the gray line. I would argue on this data, there's probably a week delay because Thanksgiving was as late as it could be. It can be as a full 6 days earlier. It basically varies from, if I got my math right, from the 22nd to the 28th is the fluctuation in November where Thanksgiving can happen. And I start my real estate year that all this data is based on March 1st every year. And then I march forward 7 days at a time until I'm all the way back to February 21st. And then on February 21st, I jump forward 8 days if it wasn't a leap year. And I jump forward 9 days if it was a leap year. And then I continue on. So I'm comparing the same date for all 10 years. Most holidays, there's a shift of up to a week because most holidays are Monday holidays. Some are date sensitive, like Christmas, New Year's, July 4th, I think are the 3 date sensitive holidays that we still have. But you can see that the trend is downward or cooling off of the marketplace, larger price reductions. This is why I call it a tight metric. On average, all the sellers are only doing a 1.2% price reduction, a far cry from the 14.5% or whatever it was for the 10% of the sellers that are taking the largest price reductions. Here you can see that compared to normal, so you've been climbing gradually up through with some fluctuation, and that would be the trend. Basically, compared to normal, sellers are taking less and less price reductions. Here's the frequency of price reductions. So how common are those price reductions? And it's really the frequency that increased. You went from about 17% of the sellers doing a price reduction to 20%. A 3% increase is pretty significant when your base is only somewhere around 15. That's basically a 20% increase in the number of sellers taking price reductions. Compared to average, you can see you were down here and boom. Yes, you were getting pretty low, but to go up dramatically like that in 1 week is pretty significant. It may continue for another week or two, but remember, we have a huge weekly cycle, and as soon as we get past the holidays, the price reductions are going to start going down most likely, and most likely prices will start going up. And that's based on buyers coming out and purchasing before the sellers come on the marketplace. Sellers are later coming out than buyers. Now we look at the frequency of those price reductions compared to normal, so you can see the improvement, and then you broke from something like 80% to a little bit over 100% in basically 3 weeks. There might be one data point here, one data point there, and one data point there. It is a condensed scale, even on the expanded side. Now we're looking at the magnitude of overbidding. You got to remember on overbidding, I need the sale price, and therefore it's delayed by the length of escrow. Length of escrow is even varied depending on not only the transactions, but the more time of the year we are. When the market is more competitive, as the typical escrow shortens in duration, as the market slows and there's less competition, the length of escrows expands slightly. I'm not talking about a huge change, but it's the fastest you're going to really close the typical loan transaction is about 3 weeks. There's more 3-week closings when the market's absolutely on fire. The long time frame is probably 5 weeks. Typical is probably 4. So there's not much of a fluctuation, but it does change when the peak happens. And what we're looking for is leading indicators, things like new inventory, new number of offers. What the sold price was is worthwhile to know. It's a point of interest, but it doesn't tell you what the market's doing. In any case, the amount of overbidding right now is somewhere around 2.5%. That is the median overbid. So half the bids are higher than that, and half the bids are lower than that, including sometimes below. A lot of times, the 5% number I was quoting earlier is the average. I do use average and median, but I try to make it clear on which one I'm using. Here, I'm using the median. Here's compared to normal. So you can see we've been running up a little bit above normal with some fluctuation. You can see third quarter, halfway through, we got sort of to a low spot, but right now we're back up and we're having more aggressive overbidding than we typically do. You can see the huge aggressive overbidding as a result of the pandemic, and then you can see the huge decrease that we had in 2022. I think this is the steepest decline and the longest duration decline that I have seen in my career. Here's the overbidding frequency. So now we're looking at how common is overbidding, and somewhere around 62.5% of the sellers are bidding more than their asking price. That is more than normal. Normal would be straight down from there. So about 59% of the sellers getting more than their asking price. And the least you'd expect is all the way down here around 49%. The most you'd expect is way up here, somewhere around 75% of the sellers are getting more than their asking price. But as I said, currently it's about 62.5% of the sellers are getting more than their asking price. Here's stretching out the gray line, and you can see right now it's quite a bit higher than normal, which indicates there's more buyers than there is inventory. Buyers wouldn't be overbidding if they didn't think they needed to get the property. Here's the long-term prices. This is on log paper, which I prefer because you get a nice straight slope like that for your estimated appreciation. It would be actually the slope through here best fit, but I just freehanded that graph in there, so it may be off by a little bit, but you can see it follows the data pretty closely. You know, you'd actually be up here a little bit higher than a little bit lower in the recent years, but I just did a straight line for the last 11 years. You can see had a little bump up in price, but we're basically just over $1.6 million for the median sold price for the Silicon Valley, the 3 counties. Here's your payment, or I am using a 30-year fixed 80% loan at the national rate average. You can get better than that typically by borrowing jumbo money or by having relationship banking. That's getting more and more common, but these are just rough estimates of what those payments would be on the different properties. It takes into consideration the current price and it estimates in property tax and insurance. Now we're going to look at a distribution. So the current line is the purple line, but we're actually starting off a year ago. So we're going to talk more about the blue dash dotted line here. This is where the marketplace was a year ago. It's every transaction. How long was it on the market for before the offer was accepted? So 75% of the sellers a year ago were on the market for less than 30 days. 90% of the sellers were on the market for less than, it looks like about 57 days. The blue line, the year ago line, is cooler than the current purple line. So the market now is hotter than it was a year ago. But the concept here is we're going to step off and we're going to start off going 5 or 4 weeks at a time, trying to keep the date of the month the same. So you see January the 3rd, February the 4th, March the 8th, April the 5th, May the 10th. We're jumping 4 or 5 weeks. I don't do anything on a monthly basis. I believe real estate is too driven by the weekend activity to look at things monthly. I know almost everybody else does look at data monthly, but when you look at monthly data, did that month have 4 or 5 weekends? And it's really not did it have 4 or 5 weekends. Most of the offers are reported to the MLS on Tuesday through Friday. So the number of Tuesday through Fridays you have in a month becomes pivotal on your data. By using 5 weeks worth of data, I always have 5 Mondays, 5 Sundays, 5 Thursdays. It doesn't matter. There's 5 of everything. And that's the main reason I did what I did. So we're going to step off and you'll see that the market cools off, then it speeds up, then it rapidly comes down, and then it does a long summer bounce. So let's step through and let it go. There's sort of the slowness of the marketplace we're approaching, and there's sort of the peak of the marketplace. Now you're doing the spring cool down. And from that point on, there really isn't much change in the data from week to week or month to month, or 4 weeks to 5 weeks. And now you're in the week. I do go to weekly starting 13 weeks ago. And now you can get close to current data, and there's current data. We have this huge slowdown every year right about this time of the year. It basically starts with November 1st. It starts slowing down, well, closer to November 15th, and it depends on when Thanksgiving is. Thanksgiving's the trigger point, but it slows down going into Thanksgiving, slows down more for the end of the year holidays, and then it turns around and fires off. The first full work week that weekend is when, in my opinion, the market takes off. Now we're looking at price reductions. What we're doing here is the same concept. The blue line is where we're starting off, and I'll warn you ahead of time, the blue line is basically at the bottom of the data. So between December 6th of 2023 and January 3rd of 2024 is basically where the sellers are taking the most price reductions last year. And that's about when they take the most price reductions every year. So we'll step through. You can see it's already a little bit higher. Now much higher, way up here, coming up. Now we're probably going to hit the peak. Right there, it's the peak, the least price reductions. Now you're already cooling down 7 months ago, 6, 5, 4. And now we changed from monthly data 3 months to weekly data. So now you're only 12 weeks, 11 weeks. So you can see with weekly data, you're going to move around here very little bit. It basically bounces. Not much movement up or down. It's basically just statistical bounces up and down week to week. There's a downward trend. There's a big downward trend, another downward trend. And I would expect that when we're looking at a weekly, because we'll be back next week, we'll probably be down below the purple line, this current purple line. And that's basically going to say that we're a little bit more price reductions this year than we were last year. And this is good because it gives you every transaction. So you can see the shape, you can get a sense of, what percent, what magnitude of each sellers are doing. It gives you way more information than percentiles. It's basically every transaction. I only start at 2.5% and 17.5% because most of the data, in fact, you can see all these data points up here, all the data above 17.5% was at 0. These data lines would have data, but there's so few of them, and you can tell the market's slower. There's no reason to go further out than that, and that gives you a nice distribution. The vast majority of the sellers are doing no price reduction. In fact, here at the peak of the marketplace, 90% of the sellers right here are doing no price reduction whatsoever. And our best week ever is the red line up here on the top, Valentine's Day of 2022, I think it was. Less than 2.5% of the sellers were taking any price reductions, but that's when the market was just about at its peak. Here's overbidding, same concept, lagging indicator. You can see the blue line is below the purple line, so the market's hotter this year as far as overbidding. And again, the same sort of distribution right through here is where the separation is the most. You start getting down here around 50 percentile, and the two lines are on top of one another, but it allows you to see the shape. Stepping through there, you can see, because it's a lagging indicator, there's a month where it's lower. You're jumping up the spring run up. There's 7 weeks, 7 months, the peak of the marketplace. Now you're coming down. Now we're basically going nowhere. For 4 months, we go nowhere. And we're on weekly data now, and you can see there's really no movement. And still no movement, and there won't be any movement because of the lag time. The reason there appear to be movement on this last one I added in the data a year ago, the purple line, the current data line, is right on top of all the other solid lines. 5 weeks from now, I'll expect that purple line to move down and be lower. But right now, we're going back in time and the market was stable. Here's looking at the 3 counties. So now you can start looking at what's going on between any one of the counties that in Silicon Valley that interest you. Gray is Alameda County, blue is Santa Clara County, and orange is San Mateo County. Basically, the big takeaway on this slide is you can see that Santa Clara County and Alameda County are typically fairly similar level of inventory. Here is a fairly significant differential. Alameda County has almost twice at 800 the inventory that Santa Clara has. Now, it's not twice because, that's number something like 435, and this number is probably more like 775. But, it's closer to doubling the inventory in Alameda County than it is that they're the same. Clearly they're not the same in these past years, but they were pretty darn close. And in most years, Alameda County is bigger. 2017 and 18 was sort of weird in Santa Clara County. We had almost 2 years worth of appreciation in the 1 year, and that's why the inventory was so slow. Everything was getting bid up, or everything got bid out, bought up, and therefore we had a second round of appreciation. Here's your offers accepted. You can see that Santa Clara County is selling more homes than Alameda County, even though Alameda County had almost double the inventory. Clearly, Santa Clara County is going to have a much faster marketplace than Alameda County. San Mateo is much smaller in size, so you can't do a direct comparison. And again, I changed the date access here on January 1st of 2023. Looking at days of unsold inventory, you can see Santa Clara County is by far the fastest county, selling out everything in 22 days. San Mateo County is actually second at about 37 days, and Alameda County is the slowest at about 39.5 days to sell all their existing inventory. Here's marketing time. How long does it take 75% of the sellers to sell? And here's interesting. San Mateo County is actually the low one. I don't know if you can see it. It's just a little bit below the blue. I would call it 32. And blue Santa Clara, I'd call 33. Meanwhile, Alameda County is up here at 43. And that's the time it takes 75% of the sellers to sell. Now your days on sold inventory, Santa Clara now outperforms. So you can see it's two different metrics of time. Moving on to price reductions, and this is the average, so it is a fairly small price reduction. Alameda County is doing the most price reductions at about 1.5% of a price reduction. San Mateo County is second at about 1.1%, and taking the least price reductions is Santa Clara County at about 0.8% price reductions. You can see that all three counties are fairly close together historically. Moving on to frequency of price reductions, Alameda County by far has the most frequent price reductions, with 23% of the sellers taking price reductions. Santa Clara County is next at just over 17%, and San Mateo County is next at just under 17%. Looking at the magnitude of overbidding, this is the average overbidding. Like I talked about, I sometimes use median, sometimes I use average. This is back to average. So San Mateo County is at somewhere just shy of 5%. Santa Clara County is just over 5. I think it was 5.4% if I'm not mistaken. And Alameda County is somewhere around 6.3% overbidding. Here's the frequency, most common in Alameda County. And that's sort of interesting. So even though Alameda County had a longer marketing time, Alameda County is having more overbidding. Typically, you would expect the more overbidding to be occurring in faster paced counties. Santa Clara County is coming in second place with only 62% of the sellers getting more than their asking price, and San Mateo County is at 61%. And I would wager you go to most areas of the United States, ask people how many of your sellers are getting over ask price. And if you told them 61%, they would think your market was absolutely on fire. Here we just say the market's actually a little slow because we have so few transactions. Here's the long-term appreciation. You can see that Alameda County and San Mateo County are right on top of one another. It's somewhere around 74% appreciation since 2015. Santa Clara County is over 100% at about 102%, something like that. And that's using the 9 months of 2015. This flat period of time here is what I used as my base year. It had the least amount of fluctuation in prices, because if you do any period like this, where you have a lot of fluctuations, it impacts your base. Here's your long-term pricing on block paper. You can see that Alameda County is basically back to their 2023 pricing. Both San Mateo and Santa Clara County are above their 2023 pricing. And you can see that San Mateo County has been going up the last several weeks, whereas Santa Clara County has been flat. Here's the same information on regular paper for those that prefer. Here's the estimated payments. It'll be the same order as the purchase price, San Mateo County being the most expensive. That's because they all go through the same formula for property tax and insurance and principal and interest payments. Now what we're doing is we're looking at the micro markets within Santa Clara County. For the first three metrics, I don't have the individual micro market area in Alameda County. I do have it for the other counties, and starting with slide map 4, I have it for Alameda County. You can see what the Silicon Valley overall number is with 79% of the typical inventory. You can see Santa Clara is only at 64, and then you can see each one of the micro market areas in Santa Clara County numbered 11 through 17. 20 is San Mateo County as a whole, and then you can see the fluctuations from micro market to micro market, and it fluctuates more. You go from a 50% more inventory than you'd expect in Foster City, so that's a strong buyer's marketplace. But again, it's a very small. I looked at it for other reasons that I'll talk about in the future. There was only 4 recent sales in the past 5 weeks, so that's less than 1 transaction a week. So that's why Foster City, you got to be careful. And I tried to put areas together that make sense, but Foster City was unique enough. It really didn't fit in with the other Bay cities. I would also look at the Bay cities to indicate what's going on there, just because with so few transactions, there's a lot of statistical movement. But even ignoring Foster City, you go from a high of 5.6% more inventory than normal to a low of 76%. So, basically a 30% swing. In Santa Clara County, I'm not sure what the swing is, Well, Campbell is the least at only 45% of the inventory you'd expect. And the most I'm seeing is, oh, there it is, 87%. So you're going from 45 to 85. So you're doubling the 45 to get to 90. So, both are significantly less than the normal level of inventory, but there is quite a bit of change. And that's, sort of an indication of why you should be looking at micro markets, not what's happening on the countywide information. Here's the same information for the number of offers. We're seeing a lack of offers, as you can see by the blue everywhere. We do have a little bit of red here in Los Altos, and Los Altos is basically seeing a third extra transactions. And from on this one and the previous, so you do have more transactions, and you can see that Foster City's got only 43% of the number of offers that you would expect to have. And that's, as I said, they only had, I think it was 4. And so if you had 33%, normally you only have 5 transactions, maybe 6. So clearly a very small micro market area. Here's your days of unsold inventory compared to historical. Pleasant Alameda County appears to have no color, and that's because it's essentially exactly normal at 99.3%. If you look at San Mateo County, even if you ignore Foster City at 350%, so way slower than typical, you go out to Pacifica, 56% slower than normal, and then you go all the way down to 85%. So you go from faster than normal in the coast, and way slower than normal in the north areas. Your Daly City, Colma, Pacifica area is very slow. We're now looking at days unsold inventory just by itself, not compared to historical. So this is sort of just, what buyers would sense. And you can see the bulk of Silicon Valley is red in color. The exceptions are the expensive areas in San Mateo County, where it would take 92 days to sell out your inventory. I consider everything up to 11 weeks to be a balanced marketplace. Only after you go above 11 weeks do I consider it to start favoring the seller. Now we're looking at marketing time. How long does it take 3/4 of the sellers to get offers? You can see the slow spot is obviously over here in Half Moon Bay on the coast, and it's taking 4 full months for 3/4 of the sellers to sell. So long marketing time there. South County is long at 60 days, 70 days, but there's a big difference between 60 days down here in Morgan Hill and 120 days out here. Most of the areas you can see a little bit of shade of blue, in my opinion, over here on the map, but if you look over here, it's not. So most of the areas are white. So that's saying that most of the areas are taking between 3 and 6 weeks to sell their properties, which is a fast-paced market. Here's the ask price reductions. What's the normal? You take off right here off the coast, 5% price reductions. That's pretty severe. That's my max is at 5. I'm at 5.1. Redwood City at 1.7%. But then you also have things like Hayward with 0.3% price increase, and Foster City at 0.7% increase. San Mateo County Bay Cities at 0.4% price increase. Here's the seller ask price frequency. This is the frequency of price reductions. You can see very frequent over in Half Moon Bay with almost 50% of the sellers doing a price reduction. Very uncommon in Foster City with exactly 0 sellers doing a price reduction. Oakland 31%, Fremont 9.7%. So that's a good example. If you were following Alameda County and doing an average, and then you're buying in Oakland, it's a totally different marketplace. And I've spent a fair amount of effort trying to put in similar type properties together, but in large enough areas that it makes sense statistically. Here's the overbid magnitude. So this is now a lagging indicator, and this is on average. Look at the Berkeley down here. Berkeley and the island of Alameda, 17% over the seller's ask price. That's huge. Only a couple areas are below the seller's ask price, and those are going to be the expensive areas in San Mateo County Coast, and surprisingly Pleasanton. And here's 2 areas: Pleasanton right next to Fremont, and Fremont's 5% price increase, Pleasanton's 0.2% decrease. Then you go up to Livermore and Castro Valley and Dublin, and it's a 3% increase. So clearly Pleasanton is a different micro market area than those surrounding communities. Here's the frequency of overbidding. How common is it? And again, it's pretty widespread. And that means you're basically saying 50% or above the sellers are getting more than their asking price. When it's white in color like the coast, it's between 33% and 50%. It's hard to tell, but the expensive areas here in San Mateo County have a light blue tint to them because it's a little bit below 33% at 32%. The map has a background color, which unfortunately I can't get rid of. So It's sometimes hard to shade, but you can come over here and look at the background on white paper. Now, this is long-term appreciation, very telling graph in my opinion. You can see the peninsula areas have had the least well appreciation. The less desirable, the longer commutes have had the best. Livermore used to be, at least from memory, and I could be wrong, but from memory, used to be brighter red. And now I think what's happening is people are already being forced to go back to work more often, whether it be 2 days, 3 days, or 4 or 5 days a week. And so therefore the commute is starting to take a toll, and Livermore is becoming less desirable again than the more inlying areas. Here's your sold price, and instead of following just the median, which is the middle number, I follow the cheapest 10 percentile and the most expensive 90 percentile in a given area. So that way you can sandwich the price. And if you start off with a price range, you can see fairly quickly what micro market areas you can afford. You can also see the outlying areas are more affordable. The close-in areas are more expensive. Here's a summary. You can start off with the geographical area you want over here on the left and see the market conditions, or come over and look at either the monthly payments or the total purchase price, and then pick what micro market areas you want from this side, from the right side, and come across and see what kind of market conditions you are going to have. The yellow are sort of leading indicators of where the market's doing. The orange are lagging indicators because I need that sold price. And you can see that there is a difference, but any given micro market area tends to either be red, like in Sunnyvale, Cupertino, or it tends to be blue, like the San Mateo County coast. So you can really see what's going on. But then you also have areas like Foster City, which is, that real small area that I keep saying sort of out there, starts off solid blue, and then it turns into solid red. So you do need to look across and see what's going on. And appreciation isn't favoring buyer or seller, although high appreciation does favor the seller because the seller is the person that owned the property and benefited from that appreciation. Here's the raw numbers for those that we'll look at. You can see the number of new listings is decreasing the most in San Mateo County at a 13% decrease. Santa Clara County was at 2.4, Alameda at 4% decrease from a week ago to this week. Offers accepted. Santa Clara County actually had an increase in the number of offers from last week. The other two counties are down. So again, you can see that, even at the county level, the data varies. So when you look at Silicon Valley, it makes not a lot of sense because the data varies so much. And then when the media focuses on the Bay Area data, the 9 counties that touch the Bay, that really makes no sense because the conditions vary so much. But anyway, you can pick out whatever county and whatever metric you're most interested in and look at the number. Here's the low number of offers being accepted. And the takeaway is 2023 was the lowest number year transactions, followed by 2022, and 2023 is in third position. So it's the current year is the third slowest out of the last 10 and the fourth slowest out of the last 25. 2007 was slower also. That's the fourth year. Earlier this year, it was more noteworthy before June. 2024 for a lot of weeks was the worst, and then it was the second worst, and now we're the third worst. So we're improving, but we still have a lack of offers. With that, we've been talking about Silicon Valley real estate market. We will be getting into the Greater Bay Area, 13 counties next. The blue YouTube URL here takes you to the YouTube channel where I have all these weekly presentations archived, or you can type in the shorter green root URL. To get to the live presentation Saturday morning at 9 a.m., you type in the green root URL in 2024. To get to the handouts, you type in the green root URL plus H 2024, the month, year, date code. Any specific episode, you type in just the root URL. You don't put in the H, put in the year, month, date code. Just for those that don't understand, this will be changing to 2025 in the first week in January. I'm Richard Calhoun, real estate broker here in Silicon Valley. I'm willing to work with buyers or sellers in a transaction. Reach out to me any way that's comfortable for you, phone, text, email. Appreciate likes and subscriptions if you're not already a subscriber. Now we're talking about the Greater Bay Area. First region, we talked about Silicon Valley that we've already been talking about. Then we move on to the city, San Francisco and Marin, North Bay, Central Valley, and the Central Coast. Let's get into the data. Here's looking at inventory. You can see that the Central Coast and the cities are the two small regions out of the 5. You can see that the inventory has been really dropping in Silicon Valley, by far the biggest drop. You can see that the Central Valley and the North Bay that had been holding flat, it has started to drop with this last week. Here's the number of offers. And again, Silicon Valley's had the biggest drop off in the number of offers. North Bay has dropped off, but the Central Valley is still climbing, a little surprising. and the cities and the Central Coast are also rolled over. So the only one that isn't on the downward trend so far is the Central Valley. Here's the speed of the marketplace. Slowest is Central Coast. The fastest is Silicon Valley. Then you have the cities, and you have tie for North Bay and Central Valley. This is marketing time to get that offer in. Fastest is Silicon Valley, all the way up at 40 days. So clearly, Alameda County is slowing down Santa Clara County, and even probably San Mateo County is slowing down Santa Clara County. Then sneaking in under here is going to be the yellow in the Central Valley. And then you basically have a three-way tie with the Central Coast, cities, and the slowest would be the North Bay. Not slowest, but the longest marketing time. Sellers ask price reduction. The most price reductions are happening over in the Central Coast. Then you have North Bay and cities fairly close together, a 2% price reduction. Central Valley is at 1.4% price reduction. And good old Silicon Valley is coming in at 1.2% price reductions. Frequency of price reductions, least frequent in Silicon Valley at only 20%. Then you jump all the way up to something like 27% for the cities. Then you jump all the way up to 31% for the Central Coast, 33% for the North Bay. And the most frequent seller ask price reductions is out there in the Central Valley at something like 36% of the sellers are taking a price reduction. Overbidding, this is what buyers do. The cities is the highest. So even though the cities didn't look all that strong, it's got the most overbidding, followed by Silicon Valley at something like 5.4%, if I remember what the number was. That was about right. It might be 5.6%. Then you're coming down with North Bay. That's the last region that's getting more than their asking price. Central Valley is getting about 0.25% below their asking price, and the Central Coast is getting about 1 full percent lower than their asking price. Frequency of overbidding, Central Coast is the lowest at just over 30% of the sellers getting more than their asking price. Central Valley at about 35%, North Bay at 40%, cities at something like 55%, and Silicon Valley at just over 61% of the sellers getting more than their asking price. Here's the long-term appreciation. The cities by far has had the least well appreciation, followed by the North Bay. Central Valley is coming in strong, but that may be short-lived. For a while there, it was the highest rate of appreciation. The reason that it's most likely to sort of go back to normal is as more workers have to go to commute, they're less likely to be buying out in Central Valley, and I think that's the way we're going a little bit. And then you have also in the same region, you have the Central Coast up here at something like 82%. Silicon Valley is at something like 86% appreciation. And earlier you might have said, I probably said that Santa Clara County was 102%. That Santa Clara County is doing better than Alameda and San Mateo County. And that's by when you put in all three, you're down at like 86%. Here's your sold price. Silicon Valley is slightly higher than the city. So the three counties in Silicon Valley, which is Santa Clara, Alameda, and San Mateo County, have a slightly higher median price than the cities, which are Marin and San Francisco. Then the Central Coast, North Bay, and the most affordable is the Central Valley down here at about $550,000 for your typical median sold price. Here's the estimated payments that'll be in the same order, so no reason to report that. It adds in, basically, I put in a formula for interest rates and property tax and insurance. And you can see we basically increased rapidly and then we went flat in all the regions. And you have had a fair amount of swing. You know, if you can buy either at this bottom or this bottom, you know, and those bottoms are pretty consistent, you end up with lower payments, and that helps out a lot. Here's the actual numbers with the metrics across the top, the different counties across the bottom. I do have the region for Silicon Valley, and I also put in Bay Area. Not that I support that data at all, but so many of the media report on Bay Area data, I put in here more just so you can see the change. You know, days on market, 51 for Bay Area, but it ranges from 94 days down to 34 days is the lowest I'm seeing. So almost a swing of tripling. So to say that you have a day, it's going to take 50 days to sell your market. If you're in Silicon Valley, you're going to be way shocked at how quickly it goes. If you're up there in Napa, you're going to be wondering why the house hasn't sold after 51 days. Again, that's the reason I don't like regional data and why I'm a big fan of micro market data. With that, we've gone over these chapters. You can, in the description on YouTube, you can click to whatever chapter you find most interesting. Thanks for joining. Take care. Bye for now.